Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Continuing from Part 1, let's take a closer look at the financial and regulatory challenges facing coal mining companies. Understanding these trends is essential for making informed investment decisions. Limited access to capital and insurance. Financial institutions are increasingly shying away from coal. Major banks, investment funds, and insurance companies are choosing to divest from coal projects. This is due to growing concerns about ESG, environmental, social, and governance factors. What does this mean for coal companies? It makes it harder, and much more expensive, for them to get the money they need. Consider these challenges for coal companies. Difficulty securing loans. Banks are reluctant to lend to projects seen as environmentally damaging or risky. Higher interest rates. If a loan is granted, the interest rates are often much higher, reflecting the perceived risk. Insurance problems. Getting insurance for coal operations is becoming a hurdle. Without it, companies face unacceptable risks. This lack of access to affordable capital directly hinders operations and any potential for expansion. It further reduces their viability and makes them less attractive investments now and in the future. Identifying companies to avoid. Red flags for investors. Navigating the changing energy market needs a careful eye. As an investor, you want to put your money into companies that have a future, not those clinging to the past. Identifying companies to avoid is as important as finding good investments. What red flags should you watch for in coal mining companies as we head into 2025? Let us look at some clear warning signs. Companies primarily operating in countries committing to coal phase-outs. One of the biggest red flags is a coal company whose main operations are in countries actively moving away from coal. These nations are putting in place strong laws and policies to stop using coal entirely. Investing in a company whose core business is directly opposed to the direction of these markets is highly risky. Consider these regions with clear commitments to phasing out coal. European Union member states. Many EU countries have firm deadlines to close coal plants and mines. Germany, France, and the Netherlands are prime examples. United Kingdom. The UK has made significant progress in phasing out coal power. It aims for a complete phase-out by 2024. Canada. Canada is working towards phasing out traditional coal-fired electricity by 2030. South Korea and Japan. While these countries have historically relied on coal, both are investing in cleaner energy and setting targets to reduce coal usage. They are moving away from new coal plant construction. Specific U.S. states. Many American states, particularly on the West Coast and Northeast, have strong renewable energy mandates. They are actively retiring coal plants. If a coal mining company generates most of its revenue from selling to power plants in these areas, you should be very cautious. The demand for their product will simply disappear. Their assets could quickly become worthless. Lack of diversification in renewable energy transition plans. Imagine a company with all its eggs in one basket, and that basket is decaying. This is the situation for coal companies that only focus on mining coal. They have no believable plans to shift into other energy sources or cleaner technologies. Such companies are very vulnerable. The market is moving towards renewables, and companies that ignore this trend will be left behind. When evaluating a coal mining company, ask yourself, do they have a stated plan for diversification? Look for clear strategies to move into minerals needed for batteries, or even direct investment in solar or wind projects. Are their transition plans credible? Some companies might say they are transitioning, but their actions do not match their words. Check for actual investments, mergers, or acquisitions in renewable sectors. Is their business still 100% reliant on coal revenue? A company still entirely dependent on coal revenue faces huge headwinds. Companies that show no effort to adapt are essentially betting against the future of energy. This is a bet that is unlikely to pay off for investors. You want companies that are looking forward, not backward. Companies with significant debt and limited cash flow. The tough market for coal means these companies are under immense financial pressure. This often leads to higher debt levels and less cash flowing into the business. When a company is struggling financially, it cannot easily adapt to new market conditions. It also cannot afford to invest in cleaner technologies or diversify its operations. Investors must closely examine a company's financial health. Look for these signs of distress. High debt-to-equity ratio. This shows how much a company relies on borrowing compared to its own funds. A very high ratio is a warning sign. Declining cash flow. If a company is generating less cash from its operations, it might struggle to pay its bills, invest, or even service its debt. Negative free cash flow. This means the company is not generating enough cash to cover its operating expenses and capital expenditures. This is a serious problem. Struggling to meet debt obligations. Check if the company is having trouble making payments on its loans or if its credit rating has been downgraded. A company overloaded with debt and little cash is like a ship taking on water. It will struggle to stay afloat, let alone change course in a stormy sea. These companies are unlikely to weather the shift away from coal. They represent a high risk for any investor. Investing in coal mining companies, especially in regions committed to phasing out coal, presents a significant gamble for now and beyond. The shift towards cleaner energy is irreversible. Regulatory pressures, declining demand, high operating costs, and limited access to capital create a challenging environment for these companies. Instead, consider directing your investments toward the growing opportunities in renewable energy and sustainable technologies. The future of energy is clear, and aligning your portfolio with this inevitable transition offers a more secure and rewarding path. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.